Welcome back to my channel, Balance Sheets Matter. Today we're going to be looking at Amgen and do a stock analysis on Amgen. But before we get into that, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you want to get good ideas on potential stocks to buy or value traps to avoid, make sure to subscribe to my channel. And if you do want me to take a look at a stock, make sure to leave that stock in the comments and I may get to it because I frequently do the subscriber requests. But let's get into the stock analysis now. So I first like to look at some of these just top level metrics on the guru focus thing here. Sometimes this guru focus value band can be quite accurate when companies are predictable and consistent. And at least for the short term right now, Amgen, I do think probably is kind of accurate at this. You can see it's a little bit fairly valued onto the overvalued thing, but it has a pretty tight trading range overall evaluation. Its current PE is sitting at 19.34, but it does have quite a bit lower PE at 14.61. They also are a nice dividend stock as they do have a 2.91% dividend yield with a dividend payout ratio of 0.55 and a 3-year dividend growth rate of 10.2%. So pretty good if you're a dividend investor. Now let's dive into the financials here. So we can basically see their long-term revenue trend here in the green. It does slowly trend up over time. That has averaged over the last 10 years 8.3%, and that's been fairly in line with EPS at 8% as well. So I like to obviously take a look at sometimes the return on invested capital over weighted average cost of capital. Typically, biotech stocks tend to have higher returns on invested capital, which is what we're seeing. It's compared to a lot of other biotechs, you could call it relatively low, but it has been kind of generally maintaining or trending even up over time and has been maintaining close to about 20%, where its weighted average cost of capital is quite low, usually between around that 4 to 8, maybe 10%. And this is important because if the company does want to do acquisitions and expand and they do need to take on debt or issue shares, which Amgen has been doing right now, it's important that you have a higher return on invested capital than compared to your weighted average cost of capital. So that's very important for a very important metric for them at least. So as you can see, revenue trend over time has been going up, actually at a pretty good pace, but you do get these periods. For example, 2008 to 2011, it was fairly flat. Even if you look at 2015, or maybe say 2016 to 2019, it was a little bit flatter, slowly trending up. They do get bigger bursts when they do acquisitions. They buy mature, basically, drugs and pharmaceuticals. They already know what the kind of existing lifespan for them is, so they're a very predictable company in that way. Their gross margin, very high because it's a biotech company, has been a little bit lower in recent years, but is that really a big deal? Because we look at the operating margin. The operating margin the last year has been just under 36%, which, that kind of varies from year to year. On the low end, they get about 30%. On the high end, it's low 40s, so they're right smack dab in the middle right now. The one thing to keep in mind right now is they have taken on quite a bit more debt, so their interest expense is a bit higher at almost $2.1 billion. And you can see in comparison, this is the highest interest expense they've basically ever had because they are currently doing one of their biggest acquisitions ever, and that's with operating income of just under $10 billion of about $9.5 billion. So I would not say this is right now a great basically interest operating income coverage ratio. They've historically been a little bit better, not the greatest, a little bit under that 1 to 10, but it is a little bit higher right now. So hopefully when they do get that cash flow coming back in, they're going to pay down this debt to reduce this interest expense, since this can cause problems if companies get too much interest expense and then they hit a little hiccup in the future. Basically, we go down, we can see net income, even through the great financial crisis, it was positive. It's been consistently positive with, pretty consistent net margins of basically about 25%, even up to 35%. Again, right now they're spitting smack dab in the middle at about 30%. But their EPS has been growing at a pretty good rate overall. They're at $15 per share right now. And we compare this to basically, 2008 to 2010, where they were more around at $4.50, going closer to $5. And this is largely because they have been buying back a lot of shares. Back then, their shares were outstanding were over 1 billion. They've been buying back a lot of shares, returning that invested capital, return that capital to shareholders, and there's only 537 million shares left. But nice thing is they have been fairly consistent with it. A lot of companies, which I go over, they will do little spurty share repurchases and then stop when the price gets low, but Amgen has been fairly consistent. That does help keep the stock price up to some degree. So we basically look at their balance sheet now. Current assets sitting very high right now at over $47 billion, and that's a lot of cash. And you can see basically two quarters ago, and the quarter ending March 2023, they got a whole bunch of cash because they actually took on a whole bunch of debt in plan for the acquisition, which is going to be happening now, and that's going to be boosting the revenue in the future. So we have $47 billion in current assets, and that's with only current liabilities of $17 billion. So they have a very good current ratio, although this cash balance will be going down. But if you look at their historic, basically current ratios, you can see the last few years before, 22 billion, 19 billion, 21 billion. We compare that to the total current liabilities of those previous years of 15, 12, and 11. Still a very good current ratio. This is a very predictable type company. They do acquisitions. They sell pharmaceuticals and drugs out there. They have a good current ratio. So we wouldn't be expecting them to have any cash flow problems or have any bankruptcy issues at all in the future. They are sitting at total assets right now of about $90 billion, although we do have to keep in mind there are a lot of intangibles, basically $30 billion of intangibles. About half of that is probably patents for their various pharmaceuticals and drugs, and $15 billion of that is goodwill, which we kind of have to take off because goodwill isn't really real in any way other than, to make the accounting balance sheets balance effectively. And so we look at their long-term liabilities of $83 billion. You can see that long-term debt very high now, $60 billion. Hopefully after this acquisition, when they start getting more cash flow, and they're going to start paying this debt down, since you can see before for about 5 years, they are between $34 and $37 billion. And this was a big increase. But when they did have that $34 billion of debt, they paid it down a little bit and they took a little bit more. So this is one thing you kind of have to watch out on companies like this, is when they are doing these acquisitions, that their long-term debt doesn't get too out of control, and they kind of do keep it manageable, keep that interest to operating income at a good ratio, because if it gets a little bit too out of control, when they hit a hiccup, it can be really bad, and that can cause a big decline in stock price. So that's the one major thing I'd be looking at Amgen is, are they managing their debt well? Are they making sure to pay it back rather than just put it towards share buybacks? And that leaves them with total stockholder equity of about $6.8 billion. But again, $15 billion of goodwill. So technically they're sitting at negative equity. So right now, because of this debt they've taken on with the goodwill, I would say the balance sheet is a little bit on the weaker side, but in all retrospective, everything it's fine. But you're not getting any additional basically equity or additional value added from the balance sheet right now. And I would be hoping they do pay down more debt in the future. So we basically go down to the cash flow, and you can see they've had a very strong cash flow from operations. But the thing you need to understand from this is look how much they've been depreciating. In the last 3-4 years, they've been depreciating about $3.5 billion per year, and about the 5 years before that, it was about $2 billion per year, and about the 5 years before that, it was just over $1 billion per year. And you may think, wow, they're depreciating a lot, but their purchase of plant, property, and equipment is relatively low. It's usually only like 6, 7, 800 million per year. But the thing is their investments don't go into the purchase of plant, property, and equipment. It's typically into the purchases of businesses. So I kind of summed up all these numbers before just to get a general average here. And the fact is, when you combine the purchase of plant, property, equipment and the purchases of businesses, they are spending on average every year about 50% more than they're actually depreciating. So you get a very deceiving amount of free cash flow, because you can see right now, basically cash flow from operations was, $10.8 billion with $1.1 billion of purchase of plant, property, and equipment, and their free cash flow looks really good at $9.7 billion there. But we kind of have to take a little bit more off of that, because it doesn't factor in the purchases of businesses, which is effectively a way they do reinvest in their business. So that's something important to keep in mind for this. Although the free cash flow at the end of the day is pretty good. We had about 50% of that on this. That's about $1.75 billion on accurate. You knock this off, it's not too much lower here at all, effectively, if the key free cash flow. But just keep that in mind, that you do want to kind of adjust for that with your free cash flow when you see a business that is in the business of purchasing other businesses. So we can also see a lot of repurchase at stock. It is a little lumpy. Sometimes they really purchase a lot, like in 2018 here. But every year, you can see in 2019, 7.7 billion, 3.5 billion in 2020, almost 5 billion in 2021. Almost 6.4 billion in 2022. So they do buy back a lot of stock. They are relatively consistent with it, although they have stopped their share repurchases, basically because of this acquisition they're wanting to do. That would be too much cash flow going out. This is a smart move. It lets them keep that cash, do those acquisitions, and we probably will see the share repurchases resume at some time in the future. I'm not sure exactly when. I would prefer they just started a little bit slowly and also work on more paying down that debt. So that's, again, something we're going to keep track of, how they're basically managing their cash flow between share repurchases and paying down debt in the future. And now that they are a dividend stock, you can see their cash flow from dividends has been going up over time, and they're at about $4.3 billion. We compare this to their free cash flow of 9.7, although again, we want to take about 1.7 off to kind of factor in for those purchases of businesses on average. But this is a very manageable dividend they can basically pay. I wouldn't be expecting them to cut their dividend at any time in the recent future, and they'll probably be increasing it as well in the future, as that's what they've been consistently doing. And when they do start repurchasing the shares again as well, you'll start seeing that dividend yield go up more as well. And you can see all these years, even in 2008, 2009, they were still making great free cash flow. So overall, the company is in pretty good shape. The balance sheet, a little bit weak right now. I think that's a lot just because of the acquisitions they've been doing. That's the one thing we're going to kind of want to watch for their long-term prospects. If that does start to deteriorate more and they do run into some problems, that could cause a larger drop in the stock price. But we're going to now basically jump into the interactive chart and kind of get an idea of a good valuation we may get for them. So let's first look at the revenue with estimate and the EPS with estimate here. And you can basically see they are expecting the revenue to jump quite up a bit, and the EPS is temporarily expected to jump up quite a bit because this is a big acquisition they're doing. If I remember correctly, it's about $28 or $29 billion. So their EPS is jumping from about, in this current year, they're expecting it's, what's it here? I think it's about $12, $15. Yeah, it's, let me see here. What was it back here? Oh boy, my little thing is not hopping around well. Either way, there's very big increase in EPS. It's going up to 16. I think before here, the year before, it's 12, so that's a great jump, but it is expecting to decrease a little bit in the future, and that basically is probably because some of the drugs they have, they're losing the patent on them, so they're going to be losing sales on them as well. So again, it's a fairly predictable business. They do need to do these acquisitions to keep going, and they do need to do them at good valuation. So that's something you need to keep in mind. But overall, even looking at this long-term EPS trend with a big jump and then the little decreases, is net increasing EPS overall in the long run. So now let's take a look at the price to sales ratio. And the price to sales ratio went on a little bit shorter time frame. Let's go on 15 years, since they're a different company when they're 2000, and you can kind of see the price to sales ratio, like a lot of stocks, fluctuates kind of in line with the stock as the multiples expand and the multiples contract. And something like Amgen, because they are a fairly predictable company with the acquisitions they do and predictable cash flows, it is a fairly tight range for the valuation. So after the great financial crisis of 2008, 2009, it was on the lower end, and it has increased up to this range. So you obviously have to realize that it could potentially revert back to these lower trends where it wasn't more of that 3 price to sales ratio. Right now on the low side, it hits into the low 4s, and on the high side right now, it typically gets into the 6s basically. Right now we're sitting at about 5.8. It is getting a little bit on the higher side. So this is saying the stock maybe is getting a little bit more of that relatively overvalued. Even though our little guru focus band was saying fairly valued, it was a little bit overvalued on the fairly valued side still. It is a pretty tight overall valuation range. So this is one I really do like to wait for it till it gets cheaper. I had recently bought it when it was cheaper, around 220, 230 here, and I am currently looking at selling it. I actually have a sell order in right now for 290. So by the time I post this video, I may actually have already sold this stock. But we need to basically see if the price to sales ratio is something accurate to look at by looking at the net margin here. We want to look at the long-term trend for that, because as you know, basically price to sales ratio, if the net determines your PE, if your net margin is consistent, which is why I kind of like doing it, even though your net margin may fluctuate year to year. If it is fairly consistent range, this does let us do a fairly consistent valuation for a relative valuation with the price to sales effectively. And as you can see, basically the net margin has been fairly consistent in this range. On the low side, it gets in around 20, although sometimes a little bit lower. And on the high side, it gets 30 or maybe a little bit higher. And we're right smack dab in the middle. So this whole price to sales ratio methodology would be pretty good. When you do get to start getting consistent dividend payer like this, it obviously can't afford the dividend. Basically looking at the dividend yield is also a great way to determine if the valuation is good or not. So let's pop up the dividend yield. Let's compare that to price. Go back to about 15 years here. maybe 10 years actually. And you can see again, basically the stock charts, dividend yield, when the stock's low, the dividend yield's high. When the stock's high, the dividend yield's low. It inverts a little bit. And right now, dividend yield is getting a little bit on the low side right now. So this is one of the reasons I am looking at selling it. So, you know, it's not a huge gain, but when you play these little fluctuations for short periods of time, you know, you can make 25, 30%, which is, you know, pretty good for a little short-term investment, a short-term trade, waiting for it while collecting that nice dividend in the meantime. So let's go to the overall stock chart here to get a little bit more of a technical analysis. And you can kind of see I have a very big trend going, and this is kind of, if things really start to deteriorate, things could start coming down here, although I wouldn't expect things just to immediately crash. Probably would start losing the short-term trend and, you know, start coming down there. But in the meantime, you got this nice little upper trend here, which let's focus on that for a little bit. And this is kind of at least my investing, and you can call it trading strategy with Amgen, is when the stock gets relatively cheap because I like its overall fundamentals and I don't see any deterioration. I basically like to, you know, buy the stock here, buy the stock here, you know, could have buy the stock back there. And then when it gets into this upper valuation here on these little spikes here, you know, that's a time to take profits and potentially sell it. I don't look at Amgen as a long-term buy and hold. I like to opportunistically buy it, then opportunistically sell it. And if the stock basically, you know, comes basically back down here, I'll be looking at it being a buyer of again when it probably gets under 250, maybe 240, maybe a little bit lower. But I hope you gave that gives you some insights in Amgen, along with the fundamentals, along with even how my approach of basically buying and selling it is. So remember to subscribe to my channel, like the video, and I'll see you in the next stock analysis video.